In this video, we're going to show you the best technique to combine multiple time frames to get a well-informed and clear chart analysis by combining price action and smart money concept. We will demonstrate how to effectively make a top-down analysis to identify the market direction, supply and demand levels, liquidity zones, and trading opportunities from higher time frames to lower details. So guys, if this is something that interests you, please hit the like button to show your support and subscribe if you're new. Okay, let's dive into a video. What is top-down analysis? In simple terms, top-down analysis is like looking at the big picture of the market. Instead of just focusing on one thing, it considers different time frames and factors that affect the market. By doing this, we can get a full and clear understanding of what's going on in the market. Starting from higher time frames and zooming into lower details allows us to get a major view of market direction in key areas at all levels. But remember, starting from the monthly time frame, applying every single concept out there will make your chart look like completely mess. This video will tell you what to exactly look for in each of the time frames to make a hundreds of dollars sniper entry analysis of any chart easily. But first, why do we even need to combine multiple time frames? Well, here are the top 3 reasons. Number 1, overcoming directional confusion. Here on the pound dollar 5 minutes chart, the market looks choppy without any visible direction. It continuously violates the structure levels to both up and down sides, confusing any trader trying to identify the direction. But if we zoom out to 1 hour's time frame, you can easily identify the market trend and the bearish pressure. This area is the same area on the 5 minutes chart we were previously confusing, so by knowing the higher time frame directional bias, we can take short entries with confidence. In the 5 minutes chart, remember that whenever you are confused about the direction and the market keeps violating key levels of structure, you are focusing on the wrong time frame. So analyzing the bigger picture helps you to improve your ability to take more precise and confident entries. Number 2, increasing accuracy. A minor reaction to a higher time frame key level can be a significant trend change in the lower time frames. So before placing any trade, we should check how much room we have before tapping into a higher time frame, supply or demand area. This will help us understand how to set our targets, stop losses, and avoid losing trades. Let's take an example. Here on the Euro-dollar 15-minute chart, we had a strong bullish move with a clear fair value gap between the shadows. As a result, we have a valid order block, which is an excellent opportunity to go long. However, the market suddenly changes direction and ignores the demand order block, and your money is gone. In that case, you are wondering, why? Here is the answer. If we zoom out to the 1 hour time frame, we can see that this change in direction could be due to reaching a higher time frame key level that acted as strong resistance multiple times previously. So checking the higher time frame key levels could help us avoid this kind of unnecessary risks. On the contrary, look at another example. Here in the 1 hour time frame, we have a move with obvious inefficiency breaking above the previous market structure. So here, if the price manages to pull back to the order block zone, it would be a perfect opportunity to enter a long position. Set our stop loss below the swing low and target the next level of market structure. Let's see what do we have on the higher time frame. Here on the 4 hours, we can see that we have recently broken above these supply areas. So demand is in control, and we have enough room to go next unmitigated supply area. That means it could be a perfect trade since we have combined higher time frame levels and directional bias with a lower time frame entry setup. Number 3, optimizing trade entries. Analyzing multiple time frames allows traders to identify optimal trade entry and exit points. For instance, imagine if you were waiting for the price to pull back to the order flow area and open buys to go along with the bullish momentum. If we set buy orders at the beginning of the zone, our stop will be too large. So an optimal way to trade is to look for confirmation and open longs in lower time frames. This confirmation helps to reduces the false signals and increases the trader's confidence in their analysis. Now that we have discussed the importance of a multi-time frame analysis, let me show you the best technique to combine multiple time frames to get a well-informed and clear chart analysis. But before we continue, if you have enjoyed this video so far, please smash the like button to show your support. This will help me a lot. Now let me show you our top-down analysis technique step by step, which is the process of going through a higher time frame and scaling down to the lower details to identify best trading opportunities. We consider three types of time frames in our chart analysis. Starting from higher time frames, first we have weekly and daily, which we only use to identify higher time frame key levels of the market structure. Second, we use 4 hours and 1 hour time frame to do most of the analysis, including identifying market direction, supply and demand areas, order blocks, liquidity zones, and trading opportunities. For third, we use 15 minutes and 5 minutes time frames if we needed more confirmations and entry reasons in lower detail. Now let's apply these concepts on the real chart of multiple pairs to completely understand this technique. Here, we have euro-dollar on the weekly time frame. In the first step, we mark the key levels of market structure that price have recently reacted to. We want to keep our analysis simple, so we only draw the most recent levels near the current price. For example, this level is our historical top, which has recently rejected the price twice. We have another key level in front of the price which has acted as support multiple times. Also, we could draw another key level here. Now this is the only thing we need from the weekly time frame, which is the key levels of market structure that have a high chance for price to react to when it taps into them. So let's zoom into the daily. On the daily time frame, first we adjust the weekly levels to get the greatest number of touches from the daily perspective. Second, we draw the daily key levels of the market structure with another color. The reason is that we want to be able to distinguish the weekly and daily levels. When we zoom into the lower time frame, since the higher the time frame, the greater the importance of a level. Now this was also the only thing we needed from the daily time frame. But remember, you need to keep three things in mind when drawing levels of market structure. First, draw the levels where you could get the greatest number of touches. Second, drawing from the bodies of the candles has a higher priority. Third, treat the levels as areas, not solid lines. Also, there are 5 criteria that we look for when identifying key levels of market structure, and each one of them makes a level more powerful. Number 1, the turning points. Turning points are the areas that have reversed the market trend previously. The market sees these areas as overvalued or oversold, and there is a higher chance for the price to react to these levels when it reaches them again. Number 2, multiple rejections. Multiple rejections from an area show that traders took action at the same level at different times, making it more powerful. More rejections are better, but it won't guarantee that the level will hold when the market taps into a level. We closely watch price action to indicate what is happening. If the rejections are getting weaker every time, there is a higher chance for the price to break through this level, but it will be strong support if the price reaches this area again. Number 3, acted as both support and resistance. If a level of market structure has acted as both support and resistance previously, it increases the probability for the price to reject this level again. Number 4, the move away from the area was drastic, meaning that not a tiny reaction but a true reversal. The deeper the return from a level, the more important that level is. Number 5, recently respected or created levels. The recent levels in front of the price are always more effective since they are current and new, whether they are traditional support, resistance, or order blocks. Now, with all being said, let's zoom into the 4 hours time frame to continue our analysis, which is where the smart money concepts come in here. On the 4 hours, we have both weekly and daily levels visible on the chart. Each of these levels can act as strong support or resistance when the market reaches them. But remember, more trades do not mean more profits. So guys, I hope this video provided some value for you. If it did, please hit the like button to show your support and subscribe to our channel if you're new. Also, don't forget to comment below with your thoughts. See you in the next episode.